All right, so Juho from the European Investment Fund will be sharing the state of the European venture capital markets of bird's eye view. So if you are looking for returns here in Europe, I know there are a couple of LPs that are new to this region and are curious about the top decile, top percentile, top quartile, all of the above. This is the guy for you, right?
Absolutely.
All right, round of applause, European Investment Fund, Juho Aminov.
Thanks for the intro, Sarah. Thank you, Jan, for the invitation. Looks like it's been a few years since I was here last time, because at least my hair changed color since I was previously speaking here. But great to be sharing the European Investment Fund's view on what is the state of the European VC market today. Probably most of you know who we are and what we're doing, but just to put things in the context, so we are the venture capital fund investments arm of the European Union. We mainly invest funds from the European Investment Bank, the European Commission, the EU member states, and also private investors in different venture strategies. Last year we did 5.6 billion in new commitments across different strategies, from VC to later stage growth, as well as lower mid-market buyout. And by now we have more than 40 billion euros committed in a portfolio of more than 1,500 funds. And we are a Luxembourg-based investor. We have a team of more than 40 investment professionals in our fund team. We've been doing these investments for over 25 years now, and with the size of the portfolio I mentioned earlier, obviously we have fairly good visibility of how the asset class has performed. And if we look at Europe on the global stage, we can actually see that over the last 10 years, the relative share of Europe as a destination for VC investments has increased to record high levels. So whereas we looked at 13% in 2013, that figure had gone up to 19% by 2023. And even more interestingly, if we just look at the early stage component of global VC funding, Europe stands currently at close to 1/4 of global VC funding. And it's obviously not only about investments, it's also about returns. And this is a figure from a study by Invest Europe from last fall. So European VC funds taking part in the study have reported net return of 23% on their investments from the last 10 years. And noteworthy is that this figure has gone up considerably in the last 10 years compared to when these companies and these investors were incepted. So we're definitely seeing an improvement also on the return front. And you might ask, why is that? Of course, it's the flywheel spinning in Europe. So we've had the first wave of successful European companies being founded in the 1990s and early 2000s, then being exited. And actually we see the success stories that are the vital component for every ecosystem. So people can see that good companies can be created and exited everywhere. And these then become role models for the next generation of great founders. And also the founders who have exited their companies in the first cycle not only bring their expertise, but also capital that they generate from these exits for the next wave of successful companies, either as business angels or even VC investors. And this is clearly the foundation for thriving VC hubs we see all over us. So you have Helsinki, also Tallinn now on a very nice track coming up there as well. And yes, no doubt last year was a very bleak year for VC. And a lot of the unicorns that we saw created in 22 and 22 in the overheated markets were dehorned last year. But the positive is that still, despite the very challenging fundraising environment, we still saw at least a handful of even new unicorns being created in Europe. And this goes back to what I said earlier, why unicorns matter. Of course, not every company that reaches unicorn valuation will get exited at 1 billion valuation. So for investors, they may not bring the greatest return. But what is noteworthy here as well is that every company is a foundation for potential next unicorns. And in a way, unicorns create also babies, of which many may become the next unicorn and even the same city. So they actually fuel and make the flywheel in the relevant ecosystem spin faster. Then let's go to returns. Seems like the animation here wasn't working the way I hoped, but this shows the EIF data for European VC performance for vintage years 1998 till 22. And you see the candle bars on top of the vintage year, which shows you the cutoff points for performance quartiles for that given vintage year, where the uppermost dash represents the cutoff point for top quartile performance in that year. So for 1998, to be in the top performance quartile, so top 25%, you needed to show a net IRR of more than 5%. This is the midpoint, so the median return for this vintage year. And then if you're in the bottom quartile, you're somewhere below the lower dash here. So what can we see out of this graph here? So first of all, clearly the 5 years after we started investing in European VC, the returns were lousy, no doubt. So with on average 3% net IRR, you were already in the best 25% of the bunch. Now, after the tech bubble had burst, obviously the industry was in big turmoil and had to reinvent itself. And we saw some improvement also in returns. So the 6 years after that, the top quartile cutoff point had gone up to around 8% net IRR. But it's really after the financial crisis when the paradigm shift really took effect, because in the years since 2009, to be consistently in the top quartile performing funds, the minimum net IRR that you need to show is in the range of 16%. That already starts to be really competitive. And it's not only the upside, also if we look at the downside, and some of the loss-making funds in our sample. So after 2009, there have been only 4 years when you would have been losing money as an LP, and only if you invested in the bottom quartile funds in these 4 vintage years. And here noteworthy is also that 3 out of the 4 vintage years are still very recent, so it's fair to assume that these portfolios are still maturing, and at least some of these funds will show an uptick in performance in years to come. So this at least shows you the value of diversification over time. If you systematically allocate funds to European VC, the chances are, or at least historical data shows, that the chance or the likelihood that you would have been losing money on investments in European VC are very, very slim. And of course, the best funds continue delivering strongly. This shows the performance of our top 50 performing funds. So our number 10 best performing fund has a net IRR of close to 50%. And it's obviously not only 10 or 20 funds, even the top 50 fund in our portfolio has a net IRR in excess of 25%. And what sort of funds are performing? Here you see the best performing, or 5 best performing funds per vintage year by fund type. And interestingly, if you look at the best or second best ranking funds by vintage year, for a relatively long time, actually first generation, so first time funds actually represent more than 1/3 of the best and second best performing funds in our sample. And that's a bigger share than what we have with blue chip funds. So I guess at least you can derive out of this picture is that if you would systematically omit first generation funds from your strategy, you would also be likely to miss out on some great returns. And also, we have an increasing number of European funds who have found the recipe for success so they can repeat systematically strong performance. So we have 2 GPs in our top 50 pool that have 3 of their funds ranking in that list of 50 best funds, and 5 GPs that have 2 of their funds. And if we extend this sample to 100 best performing funds in EIF's portfolio, which by the way still is generating 20% net IRR plus. So we have 1 GP that even has 4 funds, 4 separate funds in that sample of 100 funds. And then obviously we often hear that, well, what about in comparison to US? So how does Europe fare there? And actually we have to say not too bad at all. So this is data from PitchBook, the top quartile cutoff points for European and US VC. So from 2005 onwards, we see that the top quartile cutoff point for European VC funds actually has been outperforming US in 10 years out of 18. So relatively tight race, but no reason based on this data to say that European returns would somehow be trailing their US equivalents. So our view is that what we're going through now is more a correction than a downturn. So clearly markets got overheated in 2021 and 22. But if we exclude those 2 years, we're still looking at relatively stable growth that we see for the last decade. And whereas the correction maybe that we witnessed in 23 took somewhat longer than many of us had assumed, we still believe that there are healthy elements to believe that we're on good track to see also good returns going forward. So with the interest rate outlook also moderating, we see public tech stock valuations coming back. Also, we see more growth rounds taking place 24 than we had seen last year. So clearly, the sentiment in the market is improving. We've had also in our portfolio a handful of encouraging yet smaller exits this year. Exit market probably will still require a bit more time to come back. And of course, that will have a fundamental role to the LP universe at large to invest more money in VC funds. But in general, we are very positive that the European VC fund has fared well, even in the difficult market environment we had over the last couple of years. And we look forward with optimistic expectation when it comes to return to LPs. So that concludes my presentation. I thank you very much for your attention, and it looks like I saved you 15 seconds. Thanks.
Thank you. We have time for one question. If you have a burning question for Juho, anyone? All right, you are out of the heat. Okay, Carmen.
I'm curious about the AI landscape in Europe.
AI landscape in Europe.
Yeah.
Obviously, that is, we invest in different types of thematic strategies. Of course, AI, we have seen the increase of AI, both in terms of generalist fund allocation as well as dedicated AI funds in our portfolio in this decade. We also have, and of course that is a policy priority also for the European Union, which we very much represent. So we also have dedicated programs to, help Europe in the race in AI. But of course, seems like depending on whom you ask, AI is everywhere. So, but yeah, we see good companies coming out of Europe also in that field.
Thank you, Juho. And for that question, maybe we'll have a panel on the intersections of climate, AI, fintech. So stay tuned for that. Juho, a round of applause one more time.
Thank you.
European Investment Fund, thank you so much. Thank you. Is that yours?